Hello and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's go watch the analysis.
All right, let's look at the tape. As of, February 12th, 2026, Trimble Inc., ticker TRMB, was trading at $66.01. So up about 88 cents or 1.35% on volume of just over 3.5 million shares.
Right. And then fast forward 24 hours to the close on the 13th, and you see that price nudge up to 66.40 after touching a high of 67.47. Puts the market cap right in that, $15.8 to $16 billion range.
Exactly.
But, precision is key here. So let's contextualize that price action before we get too excited. That 66.40 print, it sits in a fascinating and I would argue pretty precarious spot. We are substantially off the cyclical lows, up about 124% from the bottom. However, and this is the important part, we remain significantly below the 52-week high of 87.50. So the market's recovering, sure, but the chart is messy. It has not signaled the all clear just yet.
Well, it hasn't signaled all clear because the market hasn't fully digested the math I'm looking at today. And that, I think, brings us to the central premise of our debate. So Trimble is currently valued at, let's call it $16 billion. The question, and the one I'm arguing in the affirmative, is whether this company can achieve a five-fold valuation increase. We're talking an $80 billion market cap over the next 10 years.
A 5x return is a massive, massive hurdle. You're talking about a company that for decades has been viewed as an industrial hardware player, right? The people who make the GPS sticks for surveyors. And suddenly it's supposed to command the valuation premium of a high-growth SaaS monopoly? My stance is simple. While the stabilization we're seeing right now in February 2026 is real, the path to $80 billion relies on some, let's just say, aggressive assumptions about multiple re-rating, about macro stability. And those assumptions just don't align with the technicals or the execution risks we're seeing.
I understand the skepticism if you're only looking in the rearview mirror, but let me offer the position based on the fiscal 2025 results that were released just a few days ago, February 10th. The structural shift is no longer a projection. It's complete. We are looking at a revenue mix where software and services now represent 79% of total revenue. That is not a hardware company anymore.
That is a high percentage. I grant you that. It's a cleaner business model than it was 5 years ago.
It's not just cleaner. It's a metamorphosis. Look at what that mix does to the bottom line. Gross margins reached a record 74.6% in Q4 2025. That is up 1,300 basis points since 2019. For our listeners, that is a massive jump in profitability. It means for every dollar they bring in, they are keeping significantly more of it to reinvest. We have annualized recurring revenue, ARR, hitting $2.39 billion, up 14% organically. This is no longer a cyclical hardware stock that lives and dies by how many physical units it ships. This is a high-quality compounder with what the report calls degrees of freedom to reinvest. And the consensus agrees with me. 23 out of 24 analysts have a buy rating with a high price target of $120. That implies nearly 80% upside just in the short term.
I'm sorry, but I just don't buy that the transition is seamless. Let me tell you why. You mentioned the Q4 report as proof of victory, but let's look closer. Reported revenue actually declined 1% year over year. I know you'll point to organic growth, but divestitures, selling off parts of the business, have real impacts on scale. You are shrinking the top line to fix the bottom line. And if we look at the technicals, which, rarely lie about sentiment, we are seeing a bearish crossover as of mid-February. This is where the short-term moving average crosses below the long-term trend line. It's a classic signal that momentum is stalling.
Technicals can be noise in the face of fundamental shifts. You're looking at chart patterns, I'm looking at business quality.
Or they can be a signal that the market isn't convinced by this connect and scale narrative. The stock is trading at a PE, price to earnings ratio, of around 37. That is already priced for perfection. For this to go 5x, you need financial engineering, specifically buybacks, to do a lot of the heavy lifting. You have to ignore the fact that the transition in segments like field systems is creating revenue headwinds of 150 to 200 basis points. That drag might persist a lot longer than your models account for.
That's a fair concern about the PE, but I would frame the growth engine differently. You're worried about legacy drag, but you're missing the powerhouse within the portfolio. Let's talk about the AECO segment. For those not familiar, that stands for Architects, Engineers, Construction, and Owners. This is the primary growth engine. In Q4, AECO delivered an operating margin of 44.1%.
44% is impressive for an industrial software player. I won't deny that. It's software-level margins.
It's exceptional, and AR in that segment grew 16%. This isn't accidental. It is fueled by the Trimble Construction One, or TC1 framework. They are integrating all these disparate data points, design, logistics, labor, into a single cloud environment. Management has identified a $1 billion cross-sell opportunity here. Think about what that means. This isn't just selling a surveyor a piece of equipment once every 5 years. This is becoming the operating system for the entire life cycle of a building, from the first sketch to the final brick.
See, I come at it from a different angle. You focus on AECO, which is the shiny object, but you can't just ignore field systems. That is still a huge chunk of the business, $1.5 billion in revenue. This is the hardware, the sensors, the things that actually go onto the construction site. And while the machine control as a service aspect is growing, ARR up 20%, sure. The shift from perpetual licenses to subscriptions creates short-term volatility.
Volatility how? We're moving to recurring revenue. That reduces volatility.
Cash flow timing. You are taking large upfront cash payments, selling a license for $50,000, and turning them into smaller, ratable streams, say $1,000 a month. In the long run, yeah, it smooths out, but in the transition, your cash flow takes a hit. It creates an optical drag. Plus, we have to look at the macro environment. We're looking at construction firms facing high interest rates, inflationary pressures. Are they going to sign up for new recurring billing models when their own capital budgets are being squeezed? I mean, there's a real risk that the readable revenue stream grows slower than your aggressive 5x model requires because these macro headwinds elongate sales cycles.
I'm not convinced by that because the retention rates are over 90%. That is the key metric. When you are the operating system, you are the last thing to be cut. You aren't a discretionary expense. You are how they control their costs. If a construction firm wants to survive inflation, they need efficiency. Trimble sells efficiency. But let's move to the real accelerant here, the thing that changes the valuation math entirely, AI. And not just any AI, but agentic AI.
Agentic is becoming the buzzword of the month in every earnings call. Everyone has an agent now.
It's a buzzword because it represents a distinct technological leap. We need to distinguish this. Generative AI, which everyone knows, creates content. It writes text, generates an image. Agentic AI performs autonomous tasks. It takes action. Trimble is rolling out agents that can modify 3D models from text prompts or automate geometry creation in software like SketchUp and Tekla. This is delivering productivity gains of over 50% for their users. This isn't vaporware. It's already powering $100 million in incremental ARR.
That's a compelling narrative. But have you considered the competitive landscape? You're pivoting a legacy industrial company directly into the line of fire of cloud-native giants. If Trimble's value prop is software and AI, they are now competing for talent and market share against companies that were, born in the cloud.
Like Trimble has the domain data. That is the difference. You can't train a model on construction physics if you don't have the data from the job site.
Data is valuable, but speed is critical. If Trimble fails to maintain the pace of innovation against horizontal tech giants who decide to enter the digital twin space, their intelligence layer could be commoditized. Look at Hexagon AB. They are the primary competitor. They have higher total revenue and a more horizontal strategy. Being a vertical specialist is great until a generalist with deeper pockets builds a good enough version of your tool for free or integrates it into a larger suite like Microsoft or Google might.
That just ignores the complexity of the physical world. You can't just hallucinate a bridge design. The digital twin market, creating a digital replica of a physical asset, is projected to grow at a 17% CAGR to $107 billion by 2030. You need precise, physics-based models, not just pretty pictures generated by a language model. Trimble owns the intersection of the physical and digital. That is a moat. You cannot displace that with a generic LLM. The tolerance for error in construction is zero.
It's a moat that requires constant defense. Let's talk about how this actually translates to the $80 billion number. We need to look at the math, not just the technology.
The math works. To get to a 5x valuation, we need a few levers. First, revenue compound annual growth rate, or CAGR, of 7 to 9%. Second, margin expansion, EBITDA moving from roughly 30% toward 40%. And third, capital allocation. The board authorized a $1 billion share buyback program. They bought 12.2 million shares in 2025 alone.
Which is essentially financial engineering.
It's efficient capital allocation. They are reducing the share count by over 5% in 5 years. They've committed to another $625 million in buybacks for the first half of 2026. This boosts earnings per share significantly. When you combine revenue growth, margin expansion, and a shrinking share count, the compound effect is powerful. It creates a flywheel of value per share.
But you're missing the fourth lever your thesis relies on, multiple expansion. This is the most dangerous assumption. You need the market to re-rate Trimble from an industrial tech multiple to a size multiple. That contributes to roughly 1.1 to 1.2x of your growth. That is entirely dependent on sentiment. If the market sees you as a hardware company, you get a 20x multiple. If they see you as AI, you get 40x. So you are betting the house that the market just changes its mind.
Sentiment follows margin profile. As we hit 80% recurring revenue, the market will have no choice but to re-rate. The numbers will force the narrative change.
Sentiment also follows clarity. And look at the PTIX joint venture with AGCO. For the audience, this was a deal where Trimble spun off its agriculture business into a joint venture. Yes, it simplified the portfolio, but it also removed direct control over the agriculture revenue stream. Trimble now relies on royalties and a 15% stake. It provided $2 billion in cash, which is great, but it turns a core operational segment into a passive income stream.
It turns a cyclical, lower-margin hardware business making tractors, drives straight into a high-margin royalty stream. That is exactly what drives a multiple re-rating. We detached from the heavy iron of tractors and kept the intelligence. We essentially sold the body to keep the brain.
Yet, you still have exposure to things like transportation and logistics. That segment grew ARR by 7%, which sounds fine, but the global freight market remains weak. If T&L drags down the aggregate growth rate, you miss that 7 to 9% CAGR target. If you miss the growth target, you don't get the multiple expansion. The 5x math is fragile. It's a house of cards built on the assumption that every segment performs perfectly, simultaneously.
Fragile? Let's look at the foundation. The balance sheet is a fortress. Debt-to-equity ratio is 23.9%. Interest coverage ratio is 8.3x. That means they can pay their interest expenses 8 times over with their current earnings.
I agree, the balance sheet is safe, but safe balance sheets don't guarantee 5x returns. They guarantee survival. You can survive for a decade and trade sideways.
Survival is the prerequisite for compounding. We have a net debt-to-equity ratio of 19.5%. This stability allows Trimble to weather the macro storms you're worried about, while continuing to buy back shares and invest in that agentic AI. It gives them the degrees of freedom the report talks about.
It also means they aren't levering up for a massive acquisition that could change the game, which suggests they're relying on organic execution. And that brings me back to my core concern, execution risk. We are staring at a bearish crossover in the short term. The market is saying, show me.
And I believe they are showing us.
Let's break down the competitive positioning a bit more. You mentioned the digital twin market growing to $107 billion. Trimble has to win that against Hexagon AB. Now, Hexagon is the primary competitor, and they have a higher total revenue and a more horizontal strategy.
Exactly. And that horizontal strategy is their weakness. Trimble's vertical focus, being indispensable to the specific workflows of a construction site or a farm, that is the differentiator. We have customer retention rates exceeding 90%. Hexagon might be broader, but Trimble is deeper. And in the industrial world, depth is what prevents churn. If I'm a construction manager, I don't want a generic tool. I want a tool that understands concrete pouring schedules.
But depth is also what limits your total addressable market, or TAM. You're banking on the TAM expanding via geo-AI, geospatial AI, and digital twins. If that expansion is slower than predicted, say 10% instead of 17%, your 5x thesis collapses into a 2x thesis, which, by the way, is still a decent return, but it's not the $80 billion market cap we are debating.
I see why you think that, but the TAM expansion isn't just a prediction. It's a requirement of the modern world. Infrastructure is aging globally. The only way to rebuild it efficiently is through the digitization that Trimble provides. The connect and scale strategy is about capitalizing on that inevitability.
Let's talk about the PTX deal again in the context of valuation. You received $2 billion pre-tax. You're using that primarily for buybacks. That boosts EPS, sure, but does it make the company more innovative?
It focuses the company. By moving the agriculture or hardware into the JV, management can focus 100% of their bandwidth on the software-defined future of ASZO and the remaining field systems. It removes the distraction of manufacturing logistics,
Or it hollows out the company's tangible assets. You are becoming a holding company for intellectual property. That can be lucrative, but it's a different risk profile. If the IP becomes outdated because the startup uses a new AI model to bypass your patent moat, you have no hardware business to fall back on.
That is why the R&D spend and the AI integration are so critical, and frankly, the market is mispricing this risk. They are pricing TRMB like it's still selling GPS sticks on tripods. The data shows it's selling the brain of the job site.
We can argue about the brain all day, but the price action is the scorecard. The stock is stuck in the $66 range. It's waiting for a catalyst.
The catalyst is the execution of the buyback and the next few quarters of margin expansion.
I'm sorry, but I just don't buy that buybacks alone are a sufficient catalyst for a 5x run. You need organic volume growth. You need to sell more software units, not just buy back stock.
And we are. ARR is up 14% organically. That is volume growth in the software space.
Fair, but is it accelerating? The law of large numbers kicks in eventually. As you get bigger, 14% becomes harder and harder to sustain.
Which brings us back to the TAM. The geospatial market alone is projected to hit $1.5 trillion by 2034. Even a small slice of that pie keeps the 14% growth engine humming for a decade.
That assumes Trimble captures that value, not the satellite providers or the cloud hyperscalers.
Trimble sits between the data capture and the user. That is the stickiest part of the value chain.
Let's dig deeper into the actual mechanics of the connect and scale strategy. Because we've thrown that term around, it relies heavily on cross-selling. You mentioned the $1 billion opportunity. But cross-selling in enterprise software is notoriously difficult. You have to convince a customer who bought product A to buy product B, often when product B has a different buyer within the organization.
That's a valid operational challenge, but TC1, the Trimble Construction One suite, solves for that by unifying the login and data layer. It's not just bundling, it's integration. When an architect changes a drawing in SketchUp, the cost estimation in the finance tool updates automatically. That is the value prop. It breaks down the silos within the customer's own business. Once a CFO sees that, they push the cross-sell themselves because it reduces their risk of cost overruns.
In theory, yes. But in practice, you are fighting legacy behaviors. Construction is one of the least digitized industries on the planet for a reason. People like their paper blueprints and Excel sheets. The friction of adoption is high. And while you are fighting that friction, you have this bearish crossover hanging over the stock. The technical traders are seeing weakness. They see that the 20-day average has dipped below the longer term. That usually signals that the short-term buyers are exhausted.
Short-term buyers are often wrong. They are trading the noise. I am investing in the signal. The signal is that gross margins are nearly 75%. The signal is that 79% of revenue is recurring. If the stock dips because of a crossover, that is a buying opportunity for the long-term holder who believes in the 5x thesis.
That's brave talk, but let's look at the valuation ceiling again. We're at 66. The median target is 93.50. That's a nice gain. But to get to 120 and then eventually to the pricing that supports an $80 billion cap, you need everything to go right. You need the T&L segment to stop being a drag. You need the agriculture JV to pay out maximum royalties. You need the AI bets to pay off without being disrupted.
You call it everything going right. I call it executing the strategy. And they have a track record. Look at the divestitures. They shed the non-core assets successfully, they recognized that hardware was a drag on valuation, and they fixed it. That demonstrates management agility.
It demonstrates financial engineering agility. Operational agility is harder. Can they code fast enough?
Can they deploy agents fast enough?
They are deploying agents now. The productivity gains are real. When a structural engineer can automate the tedious part of geometry creation, they don't go back to the old way. That stickiness is what allows for pricing power. And pricing power is the secret ingredient to margin expansion.
Pricing power is great until the customer breaks. With interest rates where they are, cost sensitivity is at an all-time high in the AECO sector.
Which is exactly why they need automation. It's a paradox of the downturn. When money is expensive, you spend money on tech to save money on labor and waste. Trimble reduces waste.
Let's bring this to a close because I think we've identified the friction points. To summarize my view, Trimble is a show-me story. The transformation to software is impressive. 65% recurring revenue is a solid floor. But the current price of $66.40 reflects a reasonable valuation for what it is today. The median analyst target of $93.50 is achievable, sure, but the 5x thesis, the path to an $80 billion cap, requires a perfect storm. It needs massive TAM expansion in GeoAI, flawless execution against Hexagon AB and agile AI startups, and a macro environment that supports high-cost software adoption. The headwinds in field systems are real, and the timeline might be longer than you think.
And I reject the caution. The 343 targets for 2027 are a credible bridge to that 5x valuation. The vertical integration, being indispensable to workflows, allows Trimble to survive macro downturns better than its competitors. My final appeal is this. With 79% of revenue now coming from software and services, and agent tech AI rolling out to automate actual work, the market is fundamentally mispricing Trimble as an industrial firm. It is a tech platform. The $120 target isn't the ceiling. It's the first milestone on the way to $80 billion.
We will see. The next few quarters, specifically the progress of the buybacks and the uptake of the PTX JV, will determine if that bearish crossover was just noise or a true signal of resistance.
And whether the connect and scale strategy can truly defy gravity. A fascinating setup for 2026.
If you like this video and want to watch more content like this, then subscribe to the channel. Thanks for watching. See ya.